In 2017, Toys R Us still held 15% of the entire U.S. toy market. They sold 1 out of every 5 toys purchased in America. Annual sales, over $7 billion. 6 months later, they announced the closure of all 735 U.S. stores. 33,000 employees out of work. Suppliers owed $800 million. The company everyone grew up with, gone. The common narrative says Amazon killed Toys R Us. That's partially true, but it misses the real story. Toys R Us didn't fail because they couldn't compete. They failed because a decade earlier, in 2005, 3 investment firms made a decision that made competition structurally impossible. By 2004, Toys R Us was struggling but stable. Sales were flat. Walmart had overtaken them as America's #1 toy retailer. Amazon was growing, but still relatively small in toys. The board decided to explore a sale. On March 17, 2005, 3 firms announced they would buy Toys R Us, real estate investment trust Vornado, and private equity giants KKR and Bain Capital. Purchase price, $6.6 billion. But here's what matters. This was a leveraged buyout. The buyers didn't pay $6.6 billion of their own money. They put up $1.3 billion, just 20% of the purchase price. The other $5.3 billion? Borrowed. And here's the mechanism that destroyed the company. In a leveraged buyout, the debt doesn't belong to the buyers. It belongs to the company being bought. Toys R Us, the operating business, became responsible for paying back the $5 billion plus used to purchase it. Before the buyout, Toys R Us had roughly $2 billion in debt. After the buyout, over $5 billion in debt. The company's capital structure had been fundamentally transformed. And with it, every strategic decision became constrained. $5 billion in debt at 7.5 times EBITDA meant one thing: massive annual interest payments. The number was consistent across sources, $400 million to $517 million per year, just in interest. Not paying down the principal, just servicing the debt. To put this in perspective, Toys R Us' entire operating profit in many years was around $600 to $700 million. More than half of that went straight to debt service before they could invest a single dollar in their business. Meanwhile, what was happening in retail? Amazon's toy sales in 2017 for $0.5 billion, up 12% from the prior year. Walmart was expanding toy aisles and using toys as loss leaders to drive foot traffic. They could afford to lose money on toys because customers bought groceries in the same trip. Target was renovating stores and building out omnichannel capabilities. Toys R Us, their cash reserves tell the story. 2005, pre-buyout, $2.2 billion in cash. 2017, $301 million in cash. Where did $1.9 billion go? Debt service, interest payments, and fees. Because here's the other mechanism. The 3 firms that bought Toys R Us charged advisory fees for their ownership. Starting rate, $15 million annually, increasing 5% per year. Total fees extracted from 2005 to bankruptcy, approximately $470 million. Here's where the story gets misunderstood. Toys R Us management knew they needed to adapt. They weren't incompetent. In 2014, they launched the TRU transformation strategy. In 2015, they opened Toy Lab concept stores with interactive experiences. In 2017, they announced a major website overhaul. But transformation requires capital, and capital requires either profits or the ability to take on more debt. Toys R Us had neither. Their debt-to-EBITDA ratio was already unsustainable. No bank would lend more. And their profits, when they existed, disappeared into interest payments. Meanwhile, their competitors were investing billions. Amazon, building fulfillment centers, offering Prime 2-day shipping. Walmart, renovating stores, expanding toy selections by 30%, integrating online and in-store inventory. Toys R Us CTO Lance Wills said it directly in 2017. In 1 to 2 years, we have to catch up on 10 years of innovation. That's no small feat. They couldn't catch up. The debt made it mathematically impossible. And here's the cruelest part. They were still selling toys successfully. Their market share was declining, yes, but slowly. In 2017, they still had 15% of U.S. toy sales. That's $7 billion in annual revenue. Remove the debt burden, and Toys R Us was a viable, if shrinking, business. They could have adapted gradually, closed underperforming stores, invested in e-commerce at a sustainable pace. But the $400 million annual interest payment meant every year was a crisis. Every quarter needed immediate profitability. There was no runway for transformation. September 18, 2017, Toys R Us filed for Chapter 11 bankruptcy. The plan was reorganization, not liquidation. They secured $3 billion in bankruptcy financing to pay suppliers and stay operational through the 2017 holiday season. If they could have a strong Q4, historically 40% of their annual sales, they could restructure, shed some debt, and emerge smaller but viable. They needed to hit their profit targets to maintain creditor confidence. What happened instead was what Toys R Us executives called a perfect storm. Walmart, Amazon, and Target all used toys as aggressive loss leaders during the 2017 holidays. They slashed prices, knowing Toys R Us couldn't match them. Walmart became America's best toy shop, with deep discounts. Amazon sent out millions of toy catalogs. Toys R Us consistently priced 54% higher on average than Amazon for the same toys. Not because they wanted to, because they needed gross margin to service debt. Holiday 2017 sales, well below worst-case projections. They missed their profit target by $250 million. January 2018, announcement that 182 stores would close. March 15, 2018, bankruptcy court approved liquidation of all U.S. operations. June 2018, the last stores closed. 33,000 employees laid off. Zero severance. Company policy had been to provide severance for mass layoffs, but the bankruptcy estate had no funds. Here's what the Toys R Us story actually teaches. It's not that private equity is inherently bad or that debt is always destructive. It's that capital structure creates constraints that determine what strategies are even possible. When you load a company with 7.5x EBITDA in debt, you eliminate its ability to weather downturns or fund transformation. You're optimizing for short-term cash extraction, not long-term viability. Toys R Us operating business wasn't the problem. Even in 2017, they were generating significant sales and had dominant market share in a growing category. The problem was the balance sheet. $5 billion in debt made every strategic decision impossible. Invest in e-commerce? Where's the capital? Lower prices to compete? Can't afford the margin hit. Close underperforming stores? Have to pay lease termination penalties. They were trapped in a structural vice where every rational response to competition required resources the debt structure had already claimed. And here's the cruelty. The people who created this structure, KKR, Bain, Vornado, profited regardless of outcome. They charged fees for advisory services while the company they were advising bled out. The 33,000 employees who lost their jobs had no say in the 2005 leveraged buyout decision. The suppliers who extended credit to keep stores stocked for the holidays had no control over the capital structure. They all paid the price for a financial engineering decision made 12 years earlier. That's this week's story from Capital Storybook. Follow Capital Storybook for more stories like this.